Hello everyone and welcome back to the channel. This is Fair Value Finder, and yesterday United Pacific reported earnings. They missed on their earnings, but the stock ran up 10%. They chose a new CEO that they're going, and the market seemed to like that news. So the stock rallied, and we're going to take a look at, did it rally too far? Is it warranted? And just see where the stock lies today. We looked at this stock a little while back. It was right around the $200 mark. It closed out yesterday at $238 per share. So it has made some moves, and we're going to see if this is reasonable to hold or if it is a potential sell. So the revenue growth is a little low. We have what they are expecting this year and what they are actually at so far with the percentage of that goal. So they're a little shy of revenue. I don't think that they're going to miss it. I think that they'll be just fine. COGS look good. Their margins are higher. They're coming in at 62.6% at the moment. Their expenses, $7.5 million. Net profit, 62.01. They end up with a net profit of $3.2 billion and an EBIT of $4.1 billion. So they are kind of shy on a few of those metrics. They're 4% shy on net profit, 10% shy on EBIT. Earnings, they're 47% of the way there. So we'll see how things shape up, especially with new management. Hopefully they'll be able to cut costs, because it looks to me like that is one of the main problems, is debt with this company. Their expenses as a portion of revenue is pretty consistently around 60%. So that must be what they target. But their actual tangible assets and their tangible assets are low and their liabilities are quite high. So we look at the share count. They are buying back shares like crazy. They've bought back by the end of Q2 more shares than we expected for the entire year, 11% more than the shareholders' equity is $13.2 billion, which is coming in well over trend. Their free cash flow yield is typically pretty good. Their earnings yield tends to be pretty low when we look at those. So far, they're a little low on earnings yield. It's an okay number, but free cash flow they definitely have. So they could be paying down this debt. They must think it's in their favor to not be. Assets, they are kind of on track at this rate. They'll end up with more assets by the end of the year than expected. The tangible assets, I could not find the direct information on their balance sheet, so I might have to wait for the year-end report for that one. They were at 12.2. It has been shrinking. 18, 16, 14, 12. Right now, to the best of my calculations, they're at about 9.4. Liabilities, they've actually gone down, which is nice. That is one thing that we wanted to see change, because their debt to equity is very high. At a 4, we really don't like touching stuff that's under 1. So they definitely had some sort of acquisition back in 2020 that rose their debt values, and over time this should work its way off. So we'll keep an eye on that one. Right now, that is down 10% since the end of last year. So that is a very good move. The book value per share, they currently have $21.65, which is in line with what they had back in 2021. There was a bit of a dip in 2022, but they have quite a bit of cash. They have $1.36 of cash per share on their balance sheet right now. Dividend, they should be paying $5.20 this year, which at the current price is 2.6% yield. They're pretty good at growing that dividend, growing at 11.4% compounding. We are expecting next year that they would push that up to $5.30, if not more, based on how they have been raising their dividend. The share price, the share price is a little all over the place. It started in 2019 at 180. So if you bought in 2019, you're up $60 right now. You're up 30% on your position. In 4 years, that's not awful. And you also got a good dividend along the way. Your yield would be higher than the 2.5%. So let's just say you're somewhere in the realm of 3%. So 33. That's a decent return. The ROE is artificially high due to all of those liabilities. They really drag down that shareholders' equity, and that makes it look like they're a really good company because 57.54 would be great. Like we're looking for something around 60, but that's not a realistic number. Once they start to take care of those liabilities, this will be dropping. But what we're looking at for the stock, fair values in the 170s. That's where I was really hoping that it would go down to so I could buy. It didn't. I ended up seeing a lot of support at the $200 level. So I put in some put credit spreads and made a bit of money and rolled that into shares. So I own like 3 or 4 shares of this stock. But it's not a huge position for me. I wish that it would have dropped lower and then I would have been more willing. Like the 150s would be the ideal range for this stock. And that's what we're looking at here. So we're looking at somewhat declines over last year. They're kind of shy of their goal of 24.6 when last year they came in at 24.9. So there is a bit of a drop in that. Earnings, they're expected to come in at 117 compared to the 124 last year. But then next year, they're expected to perform significantly better. So we'll see how all of that shapes up. If they are able to pull that out in 2024 and they expect the numbers for 2025, this is a good stock to at least look at. I am wary of this debt to equity ratio, but I am seeing some evidence that it might not be as bad as it seems on its face. So thank you guys for watching. Please like if you enjoyed the video. If there's something you disagree with, comment if there's any other stocks you want to take a look at, any other earnings coming up that we should dive into, and subscribe so you can stay up to date with everything. And I'll catch you next time.